Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. Today what we're going to talk about is two different forms of capital reallocation to shareholders in the form of dividends and share buybacks. Alright, so let's get into it. If you enjoy the video, please drop me a like and give me a comment. Love to hear your thoughts, and let me know of any topics that you'd like me to make videos on in future as well. Love to hear those suggestions down in the comment section below. So, first off, let's talk about what is the reallocation of capital to shareholders. Essentially, when a company makes money, there's a few different things they can do with it. So, the first thing they can do with it is reinvest it within the business for growth. That's one of the things they can do with it. Another thing they can do is basically sit on the money, so just keep it in the bank or possibly pay down debt with it. And then there's two other things they can do with the money which come into this sort of category of reallocating capital to shareholders, and those two are dividends and share buybacks. Essentially, if the company can't find a way to invest money back into the business for growth, these are the most two kind of common things that they'll go ahead and do next, is either pay a dividend or buy back shares. So let's get into what those actually are and what's kind of the positive and negative impacts of each. Alright, so first off, let's talk about a dividend. So a dividend is literally a cash payment that goes out to shareholders. So here in New Zealand and over in Australia as well, this is typically done every 6 months, sometimes even once a year. The company will literally pay out cash to you as a shareholder, so that will be deposited either directly into your bank account, or you can get them to send you a check. Those are kind of the two options with a dividend. A share buyback, on the other hand, is rather than giving you as a shareholder cash directly, the company will actually go out and buy shares of itself. So if you've got shares in Apple, which for whatever reason I always love to use as an example, if you've got shares in Apple and Apple actually does have a big share repurchase program on at the moment, if they go out and purchase shares, that's a kind of another use of the capital that they can go ahead and do. And oftentimes people get a little bit confused with how that actually benefits them as a shareholder. So I thought I'd kind of walk you through what buying back shares actually means and how it can help you out as a shareholder. So let's say, for example, that we're talking about Apple. So AAPL is kind of the ticker symbol for Apple, I believe. It might actually be APPL. You guys can correct me in the comments. Either way, if we've got Apple, and let's say it has far more shares than what I'm about to use, but let's say that Apple has 1,000 shares. So there's 1,000 shares trading publicly, and what Apple can actually do is go ahead and buy back some of those shares. So let's say they've got quite a bit of cash and they go out and buy back 100 shares. And the next term I'm going to use is something that you're hopefully already familiar with, but if not, I can walk you through that too. And that's something called market cap. So the market cap, or market capitalization, is essentially the total value of all of the shares that are currently being traded for that company. So with Apple, currently this is, I think, probably around $800 billion, somewhere around there. I know they were over $1 trillion at one point. Let's make the math simple and just say that they're worth $100,000, just for argument's sake. That's the market cap of the company. That's the total value of Apple, is $100,000. So if we've got 1,000 shares, and the total value of the company is $100,000, that means that Apple is currently trading at $100 per share. So it's trading at $100 a share. There's 1,000 shares, so the market cap, or the total value of the company, is $100,000. So what Apple can do, if they've got extra cash that they want to use for share buybacks, is they can actually go out and buy back shares. So if they buy back, say, 100 shares, there's now only 900 shares available. So the fact that the number of shares that are trading has changed hasn't actually changed the underlying value of the company. Apple. So the company is still going to be worth $100,000, but there's now only 900 shares. So that means that the value of your shares that were previously trading at $100 has gone up. So give me a sec to quickly do the maths on that, because I can't do that in my head, but I'll be right back with you. Alright, sorry about that. So if we now only have 900 shares, that's going to put the per share value of Apple, assuming that they're still worth $100,000, at $111 per share. So all I've done there is divide 900, which is the new number of shares, into 100,000, and that gives us a share value of $111. So essentially, by Apple buying back shares, they've increased your percentage ownership of the company. So previously you owned 1/1000th of the company if you owned one share. Now you own 1/900th of the company. So your ownership in the business is actually increased. You can imagine this like pieces of a pizza. If you had a pizza cut into 8 slices and you owned one of them, then you own 1/8 of the business. But if that company was only in that pizza was only in 4 slices, but you still had one piece, you'd own 25% of the company, you'd own 1/4 of the company. So essentially that's what share buybacks are all about. They increase your proportion of ownership in the business, and subsequently the value of one individual share that you own will tend to go up, assuming that the value of the business overall, or the market cap of the business, remains constant. So that's a dividend and a share buyback. That's kind of what those actually mean, and some of the reasons why the company would do that. So let's get into some of the positive and negative kind of aspects of each, and which one I personally prefer a company to do that I'm invested in. Alright, so what do I personally prefer the company to do, whether it be a dividend or a share buyback? Personally, I prefer a share buyback. That is, at this stage, my personal preference by far. And I'm going to give you kind of my reasoning behind that. And this is going to vary depending on your personal situation, to be perfectly honest. So the main advantage of getting a dividend is cash flow. So you're getting money coming back to you on a regular basis. You're getting cash flow, you're getting checks in the mail, you're getting money deposited into your account. And if you're the type of person that needs to be living on your investments, dividends are going to be very, very important to you. So that's really the main advantage of a dividend is just cash flow. The main advantage of share buybacks is actually to do with tax advantages. And this is especially important in countries like the United States, far less important actually in countries like Australia and New Zealand, which I'll get into in a sec. But there's some pretty big tax advantages to share buybacks, especially in the United States. So what happens is, when a company makes a profit, they pay tax on that profit. So let's say that a company makes $1,000 and they have to pay 30% tax on that profit. So what that is actually going to leave available to pay out to shareholders through one of these capital reallocation strategies is only $700 after they've paid tax. So in many countries, including the United States, what happens when the company wants to pay that $700 out as a dividend to a shareholder? They're actually taxed again, typically at the shareholder's regular kind of tax rate, depending on what tax bracket they're in. So what will happen is, let's say that this person is charged 30% tax. Again, that's going to chop that $700 right down again, and I can't do the maths off the top of my head, but it's going to drop it, I think, to roughly $500 off the top of my head. I may be wrong there, don't take my word for that figure. But essentially there's going to be a double tax situation, and that's really the main downside of a company paying a dividend versus a share buyback. Now in countries like Australia and New Zealand, I'm currently based in New Zealand, we actually do have a solution for this double tax situation, and it's not something I want to get into a lot of detail with at the moment, but there's something called franking, which is essentially a form of tax credit that gets paid along with your dividend as a shareholder. So you can actually claim tax back on your dividends, and you avoid that kind of double tax situation. If you're based in the United States or if you're investing in US companies, that's not the case. You are going to get taxed twice essentially on your dividends, but in Australia and New Zealand there's solutions to kind of deal with that. So that's the main disadvantage to dividends, and that's really the reason why I much prefer share buybacks. So when a company buys back shares, essentially more of that profit of $700, every single dollar of that is going to be able to be reallocated to shareholders in the form of buybacks. They can use all $700 to buy back shares versus a shareholder only getting a $500 dividend. So more of that capital is going to be able to go back to shareholders, and that's a massive advantage to using share buybacks. It's much more tax efficient in that respect. So that's why I much prefer share buybacks. The only real downside of share buybacks is essentially the opposite of the dividend. So you don't get cash flow from share buybacks. Essentially you see the benefits of those buybacks by an appreciating share price, by seeing the value of those shares go up over time. And to actually realize those gains, you need to sell shares. So if you're in retirement, or if you're looking to live off your investment portfolio, to actually see some of that cash come into your account, you're going to have to sell shares. And that's the main real downside of share buybacks. But if you're in your early years of investing like I am personally, and you're investing for the long term and you're not having to pull cash from those investments to sustain yourself to live, share buybacks are by far my preferred option, just because you're getting more of that capital back at the end of the day. So I hope that makes sense. I hope you enjoyed the video. If you've got any questions or comments, drop them down below. Subscribe. I would love to see you here next time. And that's all from me today. So cheers.